from GSA Ventures to talk about, certain things that are important for aspiring investors or people that want to understand a little bit better from the investor perspective how to invest in technology companies. And today I have my venture partner, Alejandro Vivanco. He's going to be speaking about, the deal structuring and valuation, which is something that is super, super popular every time we do our sessions here. So I will pass the word to Alejandro. He will be presented this time. It's going to be about an hour. Alejandro, welcome. Super nice weather today.
Yes, thank you. So for today's session, basically this is a nice continuation of our in-life or in-person workshop that we did during the Toronto Tech Week, which was an introduction to venture capital, really, trying to cover the broad subjects everywhere from how to value startups, what valuation you assign to them, what you should be asking from the founders in order to inform yourself as a first-time investor looking to do a deal in venture capital. So this is a continuation going a little bit more in depth into the valuation itself and deal structuring as well. So for today's session, basically, we're going to have today's session and then one session next week as well, which is going to be more about completing and looking at the venture capital cycle as a whole. So what that means is not only looking at the investment portion, but also looking at the portfolio management portion and what are some of the things that you need to have in consideration when you're looking to exit your investments. So in other words, how do you go about selling your investments in order to generate your return? So today's session is really going to encompass valuation techniques. So the remainder of the valuation techniques that we didn't cover during our in-person session, and also understanding the different investment vehicles that you will encounter in these early stage deals. In terms of valuation methods, again, as a quick reminder, in terms of how we're perceiving this workshop or the stage that this workshop is supposed to encompass, this is really supposed to operate in the early stage, so seed, early stage type of investments. So anywhere between, pre-seed, seed, Series A type of thing, because the thing is, these are instances where companies themselves don't have as much information as possible. So if you're a more advanced investor or you're already used to some of the more advanced valuation techniques that you apply to more mature companies, just keep in mind that this is the toned down version, really capturing the early stage world. So we're not going to cover anything around transaction comparables, discounted cash flow, public comparables, and so on. So the Berkus method is the first method that we saw in our in-person workshop. Just for the purposes of this webinar, I won't spend too much time on this, but as a quick refresher or reminder, this is basically a very quick back of the napkin type of calculation in which you're looking to assign a certain dollar value to the different type of risk that you will be exposed to as an investor when looking at early stage companies. So anywhere from product risk, technology risk, competition risk, and so on. So you want to make sure that the more risk that you're being exposed to, in other words, the more
Okay, I think we are missing for a few seconds, Alejandro. Just let's wait until he reconnects.
The value or development of that a startup. Now, this is the scorecard method is an expansion of the Berkus method, and I think a lot of more sophisticated investors, or even if you're starting to invest in the early stage space, you will find that this might be much more comprehensive. And the first thing that we will notice is that we do have a set of additional values, which are the comparable companies. And this is very good in order for you to gauge or adjust the valuation of the startup that you're looking at in comparison to other similar deals that have been recently happening in this space. So in this case, you will basically look at other similar deals that have occurred, similar stage, similar size of company, same industry. As much as possible, so you will try to find the valuation for those companies, and then use that to calculate an average valuation for the industry or segment of the market that you're looking at. Then you're gonna do something similar to the Berkus method, in which you will assign a certain amount of risk to the different value drivers or risk factors. In this case, we will have things like, okay, how do you value or rate the strength of the management team? Are they experienced? Have they exited the company before? Do they have experience in the selected industry? What is the size of the opportunity, right? Is this a national thing? Is it a worldwide thing? How big is that market? Is it B2B? Is it B2C? You need to understand what the size of the opportunity is, and then rate it accordingly. Product technology and so on. So a bunch of different elements. Now, the different thing that you will have here is that each of these value drivers or risk factors will have a different weight. And of course, I think because we're operating in the early stage space, you will see basically much of the weight being assigned to the strength of the management team and the size of the opportunity. Pretty much because, again, these are some of the main factors that will determine whether a company is worth pursuing or not, because the rest of the things can be taken care of or can be fixed. But the strength of the management team is something that's very, very difficult to replicate or fix, and size of the opportunity as well. So these are the two most important things. But the important part, so these values you won't touch. The ones that you will play with is these ones right here, called the rating. So what you will assign is either a value between 0 to 100 or 100 to, let's say, 200. But what you're trying to basically rate it on, or what's your benchmark, is how do you compare this specific company that you're looking at versus the rest of the market or other companies that you've come across. So either you can do them compared to the companies right here that you've selected in the first part of the exercise, or again, with other founders or similar companies that you've seen, how do you rate the team, the size of the opportunity, and so on. So when you rate it at 100, you're basically saying, yeah, this is pretty much average or in line with all the other companies that I've seen out there. Or if it's above 100, then it's like, okay, it's much better than what I've seen out there, other people that I've talked to. And then if it's under 100, it's basically, you're rating it below everything that's out there in comparison. So at the end of the day, you want to calculate a factor, which is basically the weight multiplied by the rating itself. And then at the end, you will do that for each value driver, and then you will sum them up. So add them up all together and get a risk or multiple here. In this case, we get 1.23. And then we will use that number in order to multiply against the average valuation that we've computed in step one. So this will help us basically assign a value to the company that we're looking at based on an average valuation that we've seen in the market. So this really helps you calibrate the opportunity that you're seeing compared to what other investors are paying for similar opportunities out there. The third method that we're going to cover today is the risk factor summation method. So very, very, very similar to the one that we just saw, the scorecard method. So in step one, we will also take, and you can basically take the same set of companies, assuming that you're looking at the same opportunity here. So you're going to take a bunch of different companies that you can find valuation on, compute the average valuation, and then you will also assign a rating. In this case, there's no percentages, there's no weights. Everything is basically weighted equally. However, you will have not only much more extensive list of risk factors, and also you will do pretty much the same thing, which is 0 is neutral. So in the previous example, it was 100 if you were neutral or pretty much average. In this case, we will go anywhere from -2 to +2. So you will do that exercise. Basically, what is the risk or what is the experience of the management team? So in this case, it's very positive. So I will put in a 2. For example, in stage of the business, I put a -1 because let's say perhaps maybe the company is still pre-revenue or they haven't necessarily achieved a meaningful amount of sales. So maybe I'll put -1 in there. In terms of let's say litigation risk, neutral. There's not necessarily anything that jumps out for this opportunity, or I don't foresee anything meaningful in terms of being exposed to any type of litigation risk for a certain opportunity. So maybe I'll assign a 0 and things like that. So you will go through every single one of these risk factors and assign a rating. Again, this is just very high level, back of the napkin type of thing. But you will assign it a score for each, and then you will add all of them together. At the end of the exercise, you're supposed to get values 1, 2, 3, 4, or -5, -3, whatever it is. The important thing is that you're going to take whatever score it is, whether positive or negative, and then for every point, you will deduct if it's negative or add if it's positive $250,000 to the average valuation. So in this case, just again, for the purposes of the example, very simple. So we have a total score of 1. So all we get to do is add $250,000, and then we just add that to the pre-money valuation. And then that's how we determine, again, according to this method, the company that we're valuing right now and to which we rate it according to these factors, then gets a valuation or pre-money valuation of this amount. And basically, that's kind of like how you would go about this method right here. Now, the venture capital method, and this is, I think, something that many of you that are already much more in depth into portfolio valuation or company valuation will appreciate. This is slightly closer to some of the more advanced methods that you will see out there, such as the discounted cash flow method. So this one, basically, what we're looking at is projecting the estimated value of a company. But in this case, we do need to do a little bit more work because we will need to actually either use the company's current forecast or build your own. We will project, depending on the investment exit year that you're projecting here. In this case, we're going to use 5 years. That tends to be like the standard, anywhere between 5 to 7 years. But what we're looking to do is project the net income. In other words, the profit of this company around year 5. This method, however, and this is an asterisk that I want every single one of you to understand. Yes, in the startup world, you will encounter a lot of cases in which companies are not profitable for, let's say, the first 5 years or even 10 years, for example. And this is very, very usual, or I guess expected, especially, let's say, when you're looking at, for example, AI companies, things like that. Again, the more capital intensive it is, the less likely that you will see a profit in the first few years of the investment. Therefore, if that's the case for the company that you're looking at, then this method won't work at all because of the math. The formula that I will show you later won't be able to compute any value to this. So just keep in mind that in order for you to use this method, you will require the company to have some sort of positive net income by year 5 or whatever period you're projecting into. So just a small note, but nonetheless, if this is useful to you, I'm going to walk through every single step of this method. So the first thing that we're going to do is project the net income. So in this case, we're going to get a $2.5 million projected net income. Like I said, we're going to assume investment period of 5 years. So in this case, in 5 years, we expect to have exited the company. Now, the PE multiple, which is the price earnings multiple, this is something that you will look at online doing your research. The PE multiple tends to be computed per industry and so on at a company level as well. But here, what you're going to be looking at is the industry itself. So if I'm looking at a software company, then I'm gonna, literally Google or ChatGPT, whatever your preferred method is. You will look at, what is the PE multiple of software companies in the early stage, and then you will look at what that is. Because software companies, for example, will be closer to, let's say, 15, sometimes even 20, it can go upwards to that. But if you have companies that are more hardware based, maybe you're looking at anywhere between 8 to 12. So the more, again, capital intensive a company is, the thinner the profit margins are, you will see a PE multiple that tends to be much, much lower. The PE multiple, at the end of the day, what it means is what are investors ready to pay for every dollar of earnings within a company. So in this case, what it means is that for every dollar in earnings, an investor is ready to invest $15. And this is, again, this can look pretty high, but this is pretty much what you will see in cases that you're looking at startup companies, for example. Software companies, for example. Then at the end, the last step is going to be incorporating the required rate of return. This will vary between funds, investors. Typically, you will want to make sure that you have a significantly high rate of return assigned for every investment. Again, knowing that with early stage companies, some of them will fail, right? And some of them will succeed and so on. So not every single one of your investments will be successful. So that's why in early stage, you will want to assign a required rate of return. In other words, what do you require from any investment to generate on average in order for you to actually come out profitable out at the end of the day? So in this case, we will assign a 50%. Again, maybe sometimes if you're a later stage investor, this will be lower, or it might be higher. In these cases, just for the purposes of the workshop, we will set in a 50% value. But again, this will be very, very different or dependent on the industries that you're investing in, the rates of return that you're used to, and so on. So the more experience that you have, the more used to that you are in deploying capital among a specific set of companies, you will have a much better sense of what your required rate of return is. So in this case, what we will have is, I just want to show you the formula. So there's 2 steps to this. We will calculate first the post-money valuation, which we're going to have the projected net income multiplied by the PE multiple. And then all of that we will divide by 1 plus the required rate of return to the power of the investment exit year. So how many periods we are going to discount this. So in our case, what it looks like is 2.5 times 15 divided by 1 plus 0.5, which is the 50%, to the power of 5, which is the 5 periods. So in this case, basically doing that calculation, you will get 4.9 million as a post-money valuation. Now, here we really want to distinguish between post-money valuation and pre-money valuation, because here basically we're assuming, okay, this is the growth or the valuation of the company in that would happen in year 5 if the company hits those milestones, and of course after we've provided them with the influx of capital that we're looking to inject. So the company has received money in order to get to that stage. So in order for us to determine what is the pre-money valuation, in other words, what is the company valued at before we actually insert that money, then we need to subtract that initial investment. In this case, just for the purposes of illustration, we set an amount that's relatively high, so $3.5 million as an initial investment. And then you can see that basically the 4.9 minus the initial investment gives us the pre-money valuation. So in other words, this is what the company should be valued at before us injecting any money into the company.
Alejandro, I have a question from one of the attendees.
Yeah.
He's asking just to make sure the deduction amount to get to the pre-money valuation will be the total round size and not just our own individual.
Yes, exactly. So the total the total round size of whatever round you're looking at present, not cumulative in terms of from the total capital that the company has raised in the past, just using the existing round. Yeah.
Thank you. I guess that, Peter, there you got your answer. So we can continue, Alejandro.
Okay, so the cost of duplicate method, this one also we already saw last week. So I'm not gonna go over this one in this session. But what I wanna leave you with is this. So as you're going through valuing the different valuation methods and looking at your potential investments, it's very important that not only you use different reference points. So in other words, the different valuation methods that we use, but also use them at a different point in time. And the way I would do that is first, let's say after your initial meeting with any given company, like run through whatever methods you can and just try to come up with a valuation for each. And then once you've done the due diligence or have had the chance to receive more information of the company, get more clarity, answer some of the questions that maybe that came to your mind after going through their documents and maybe some of these valuation methods, then once you've been able to get an additional round of information, run through these valuation methods again without looking at your previous scores. And that will help you get a range of values for each that you will be able to essentially use like this as a football field. This is what it's called in the industry. So it's basically your range of values for each method within which the value of the company may sit. And the important thing here to note is that, of course, every method will result in a very different output because all of them are looking at different things. So it's just an exercise for you to get better sense of where the value of the company is. But here, basically, you will have to make a judgment call as to what's acceptable for you, what's too high, what's too low, and things like that, and just basically make your decision at the end of the day. So in the early stage world, most of the time you will also be co-investing with other investors. So just this will be able to help you in order to make sure that whatever deal you're being presented with, kind of makes sense, and you will be able to validate this with this information. So there's no, magic formula or, straight formula that will give you the exact value of a company. It's pretty much a guessing game at this point, especially the less information that you have from a financial standpoint. So you have to make sure that you make the best judgment call with the information that you have, right? And this is the game of venture capital. There's a lot of uncertainty, but that's why also, again, as a reminder, you do require that these opportunities are solid enough in order to give you a meaningful return for the money that you're risking. Now we're going to jump into section 2 of the workshop, which is the investment vehicles. Some of you may be already familiar with some of these, but I will simply go through each of them, when we use them, why they exist, and also some of the examples just for you to properly understand how each of them works. So as a reminder, the investment vehicles are really just or a fancy way to say these are the different tools that investors use in order to inject capital into a business. And the reason why you have all these different vehicles, and the ones that we will see are safes, convertible notes, and equity. The reason why these exist, or why different types exist, is just simply as a matter of providing enough flexibility to investors, but also founders of funding the company. Certain people will have preferences either because of the risk profile, either because of the the previous rounds that they've already raised, and so on. So depending on the type of company or opportunity that you're looking at, these will be very different, but you need to be aware of all of them. Equity is pretty much I guess, the one that you hear the most about, or maybe the one that you're most familiar with, simply because this is really just about having a direct purchase of shares into a company. However, doing an equity round does require you to actually set a valuation, also a predetermined valuation to the deal that you're looking at. So, in terms of due diligence and, things that you will need to work through or negotiate around, this will require significantly much more work. So this is why typically at the early stage, you will see, especially in the first few rounds, you will see safes or convertible notes be much more prominent, simply because they're much easier to deploy and much more straightforward in a way to understand. And then as the company grows, you get a much better perspective of what the true value of a company might be, then equity rounds are done. But nonetheless, it doesn't exclude you from being able to do an equity round at the very early stage. But just keep in mind that it does require much more work, and also much more expensive, higher legal fees from a contractual standpoint. The SAFE, which is Simple Agreement for Future Equity, was introduced by Y Combinator in 2013 as an alternative to equity and convertible notes. And the reason why they wanted to do this is simply to provide a method that is much more simpler, flexible, and easier to understand for founders, but also investors themselves. So given the nature or the qualities of this investment, this type of instrument, it does enable you to execute deals at a much faster rate. And founders love them because they're very founder friendly. There's no interest, there's no maturity date, so you're really focused on here aligning with the set of investors that are looking to back you for the long term. I think that's what's appealing for a lot of founders. Now, as an investor, of course, you need to be aware that a SAFE in itself doesn't give you immediate ownership or equity into a company. And so you're at the risk of the SAFE essentially never converting over time. So you need to make sure that the founders that you're investing in are already have in mind a next funding round in order for your SAFE to convert. Because every SAFE essentially will have a liquidity event clause, which will state that once the company raises an additional round, a price round above a certain amount, or the company sells, let's say gets acquired by another company, for example, then that triggers the liquidity event clause, which will allow you to, before that event happens, you to actually convert into an equity owner in order to get benefit from that transaction. So just keep in mind that it's something that you need to be looking out for. But in terms of SAFE notes, the ones that you will come across are either valuation cap, no discount. So this sets a maximum valuation for the conversion, regardless of the future value of a company in the next round. You also have safes that will have a discount but no valuation cap. So basically, you will simply get a discount based on the valuation of the future, what the future investors are paying, but no value, it won't be capped at a certain valuation. And then you will have also safe notes, which will have both components. So these typically will obviously, as an investor, give you the better terms, because basically you will have two layers of, quote unquote, protection that will sweeten up the deal for you. But just for you to be also mindful and realistic, these safes are nowadays very, much more rare. You will either have a valuation cap, no discount safe, or a discount, no valuation cap safe. And again, this is a negotiation process. Every single company will be different or have different preferences. So the more early stage a company is, the less traction that they have. You as an investor, you will have much more leverage. But in cases in which, rounds or companies are a little bit more popular, or they have, essentially a choice, where to take their money from, you will have to give in to a negotiation process or whatever it is that you can get from a particular founder. Again, because they will either set the terms, or another investor already, if you're co-investing, might be setting the terms, and you will just be joining the round, so you will have no direct say. But for the purposes, again, of our workshop, we will look at kind of like what the mechanism or how each of these mechanisms work. So for simplicity, let's assume that you are providing a $50,000 investment into whatever company, and the valuation cap that you set in the safe is $1 million. Now let's assume that 2 years later, the company raises a funding round valuing the company at $5 million. Now, the mechanism here, the way the valuation cap works, is that your $50,000 then gets converted into equity as if you invested in the company when they were valued at $1 million. So even though, let's say 2 years later, the company got a $5 million valuation, because you signed a safe out of $1 million valuation cap, your calculation of the ownership will be based on the $1 million valuation here. In this case, if we make the math, basically what you're getting is, this is essentially 5% of the company, right, that you're getting roughly. And then versus if you were to put in the same $50,000 in a $5 million company, then you would get 1%, right? So just by the mechanism of this valuation cap, you're basically getting 5 times much more ownership in this example. So this won't be the case in every single situation, but just to paint a picture of how the valuation cap works and how, as an investor, it protects you, or it caps basically at which point your initial investment may convert. Now, a common question is, why would a founder agree to these type of terms? And the reason, and it's a fair question, but the reason also that you as an investor and founders, if there's any founders in the room, need to keep in mind is that this is money that's being provided to you at the early stage. Basically, before anybody else believed in you, before anybody was interested in your company, or before even your company had meaningful traction or any signs that it was going to become something of a certain amount of value. So the way this works, or the reasoning behind structuring such a deal, is I'm risking, as an investor, I'm risking my capital, so therefore I want to have some sort of sweetener in the deal for me to be willing to put in the money and get quote unquote compensated for the risk I took putting this much money that early on in the company. So that's basically the rationale of why such mechanisms exist, or why a founder would agree to these terms. In the second example, which is the discount example, we're going to take the same thing. So the initial investment. In this case, there's not going to be a valuation cap, but there's going to be a discount rate of 20%. So in this case, basically, we're gonna, again, just for you to be able to compare also the two methods, we will take the same scenario in which, let's say in 2 years, the company raises a $5 million valuation round. Then you, as an investor, you will get 20% discount on that, which means your $50,000 will convert as if you invested in the company when they were worth $4 million. So here, using the discount, you can see how this, in certain cases, it much compared to the valuation cap, it might be less beneficial for an investor, but the concept still remains the same, which is you are being compensated for putting money that early. That's the reason why you're getting a discount, because basically you don't want, you're saying, I don't want to invest this early, for free before, we know any value of the company, but I'm willing, to take, and again, the discount rate doesn't need to be 20%. Sometimes it can go to 30%. Sometimes, maybe the more later stage that company is, or the more traction it is, or the more clear the direction of the company in terms of valuation is, then the discount rate may be lower. But nonetheless, it's basically the same concept. So you as an investor, you want to make sure that you receive some sort of benefit for putting in money that early into a company. So
Alejandro, sorry, one question here about SAFE. Do SAFE agreements typically use pre-money or post-money valuation cap, and why?
I mean, the safes themselves will basically include either. So it's just a matter of you to, know and understand, the like what type of like deal you're getting at. So at the end of the day, in order to calculate your ownership amount, you take the post-money valuation. But in order for you to just calculate essentially what the company is worth before putting any money, you use the pre-money valuation amount. But for the purposes of, what I'm trying to say is that either way, mention on the safe, whether it's pre-money, post-money, you yourself, you need to make sure that you are aware that your conversion will happen at the post-money valuation round. So in other words, if the safe is written from a pre-money perspective in terms of valuation cap, just know that you will need to adjust that in order to calculate how your ownership will be determined.
Okay, I hope that was good, Peter. Let us know, okay? I think we can continue.
Okay, now this one is slightly more complicated for convertible notes. So in this one, convertible notes are essentially debt instruments that at some point will convert into equity. So typically they will include an interest rate, so anywhere between 2 to 8%. Sometimes it may be higher. Again, depending on the economic environment that you're in. Maturity date anywhere between 18 to 24 months. Again, these can go longer as well. Sometimes it can also go to 36 months, but the usual is around 24 months, I would say. Then similar to the safe, you will see a discount rate and a valuation cap. In the instance of convertible notes, it's actually much more common to see both of them already embedded within. But some convertible notes might have no discount rate, and some convertible notes might have no valuation cap. So again, depending on the deal that you're entering, these terms may or may not be there. But for the most part, don't be surprised if both of them show up. The ones that will certainly never disappear is interest rate and maturity date, and you have to have one of either the discount rate or valuation cap. So just be aware of that. Now, as you can probably tell already, convertible notes do provide much more investor protection because for, let's say, the first or during the maturity date period, the instrument itself does function as a debt instrument. So you don't have equity. The company owes you all of that money plus the interest that you're earning from the convertible note. In the convertible notes, however, in practice, in venture, you will never or rarely see an investor actually claim the amount of interest that they're earning. They will simply let it compound and let it accumulate in order to essentially add it into the initial capital for purposes of the calculation at the end of the period if they wish to convert to equity. So you will never receive that interest. In some cases you might, but I'm just telling you, just be aware that in venture, it's very rare that you will ask for that interest. You will simply let it accumulate as part of your investment, as if you contributed that capital, essentially. As a quick, very basic example, because convertible notes can get very, very tricky to calculate. So just for simplicity purposes, we will look at an example in which a company has 3 million outstanding shares. The investment amount that we're putting in is 750,000, interest rate of 6%, discount rate of 25%, a pre-money valuation cap of 8 million, and a maturity date of 2 years. So let's assume basically we wrote that convertible note at these terms. So a year later, the company raises $2 million, so $2 million additional in terms of capital at a valuation of $12 million. So the valuation is 12. So the new investor share price, essentially, for the purposes of the calculation, is going to be $12 million divided by 3 million shares. So this is going to be $4 per share. Then the new investors essentially are getting 500,000 shares in exchange for their $2 million. So we have the $2 million divided by the 4 here. And then our conversion, so first we calculate that value and that's fine, but our conversion, as I mentioned before, can either happen either on the valuation cap or the discount rate, whichever offers us a better deal. So in this case, because we did have both components in the convertible note, we will have to go through both calculations in order to see which scenario gives us the best price for us as an investor. So in the valuation cap scenario, we will grab the new investor price per share multiplied by the valuation cap divided by the pre-money valuation. So the reason why we're doing this is basically we're looking at doing a ratio of, in other words, kind of like the discount that we're getting in comparison to the new investors. So in this case, it'll be $4 multiplied by 8 divided by 12, which will give us the $2.67 per share. In the discount rate scenario, we will do a very similar calculation, but in this case, all we have to do is take the new investor share price multiplied by 1 minus the discount rate. So in this case, $4 multiplied by 1 minus 0.25. That will give us the $3 per share that we see right here. Now, we're not done yet. So now, as of so far, we do know that the valuation cap scenario is the one that gives us the best scenario for us because it's the cheapest price per share. So automatically, the convertible note will convert at this the best price for the investor. But we also need to make sure that we take into account the interest accumulated. So remember earlier I was mentioning the investor typically never calls the interest. So in this case, we are letting it accumulate. So we need to be aware of how much we accumulated during the period. So the maturity date was 2 years, but the company raised this $2 million a year later. So we only spent 12 months in the convertible note before the liquidity event got triggered in order for us to make our choice. So in this case, we will only get essentially 6% for the period of 12 months that we were invested in. And it's 6% calculated as per the $750,000 that we invested, which equates to $45,000. So in other words, $45,000 of interest that we earned simply by holding onto that convertible note. Now, then we add this interest accumulated to the $750,000 because we never collected that money, and we're simply assuming that, you know what, our initial investment is as if we invested 795 because we have interest on this that we were earning. So in other words, in order for you to calculate the amount of shares that you will get is, grabbing the 795,000 divided by the 2.67, which is your price per share. And then that's how you determine how much percentage or equity you're getting as part of this deal if you decide to convert. In some instances, as an investor, you also have the choice to basically say, you know what, I'm good. I want my $795,000 back. And then the company would simply use the money that they raised to pay you back and so on. So you can either stop it there or basically convert it into equity at this rate if you decide to proceed and continue supporting the company. So this is why I mentioned for convertible notes, it does give investors much protection from a perspective of it gives you much more flexibility in terms of how you execute the investment and exit opportunities throughout the investment period. Because once you're into the equity portion, again, you will either need to resort to secondaries, which are deals in which other investors will want to buy your stake into the company, or you will need to wait for the next investment round in order to generate your exit. And these are scenarios that we will see, by the way, in the next workshop next week. But this is pretty much what we have for this week. So
that's perfect.
Any questions? This is basically the end of the workshop. This is just a quick cheat sheet if you want to screenshot it for comparison purposes. So we're happy to take any questions if there's anything that wasn't clear or maybe you want some clarity on.
Yeah, no, that's good, Alejandro. I think we had a good couple of questions there from Peter. And if anyone has any questions after the webinar has finished, please remember that this webinar is being recorded and it will be, you can see it again, in LinkedIn and in our LinkedIn page. So you can, just post the questions and I'm sure Alejandro, when he has the time, can, look at them and answer. So yes, as Alejandro mentioned, we are going to have, our next basically session in next week. And hopefully there, you will see the last portion of everything, right? So we are going to be talking about exits and, a different type of exits and any other additional questions that you have about the venture capital cycle. Just a reminder to everyone, those are like aspiring investors or pre-seed investors. Next week, we have our annual conference at CBC. So I'm putting the, the QR code there so you guys can, take a look of the conference. That's our, main event in the year, and we connect with really cool investors and startups in pre-seed. So maybe you want to come and take a look of what we have for that. In the meantime, Alejandro, thank you so much. I guess that people are going to see Canada playing today.
Yes.
At 3 p.m. So this, as we are opening, FIFA today here in Toronto. So thank you, everyone. Have a wonderful Friday. And any other questions, just post it there. Thank you.
Thank you all.